I think you got to be looking at the right market. I think what Jim is referring to is the S&P 500, and the five largest stocks represent about 23% of the index and just 16% of the earnings. But look at the equal-weighted S&P or the Russell 2000, probably a better barometer of the economy. And if you really want a holy grail indicator, look at the spread between 10 and 2-year treasuries. As that moves north, it shows you that economic activity is improving. As it moves south, it shows you that, just like Jim says, it's not that great in some parts of our economy. I hardly think that Microsoft, Apple, and Amazon represent really what's taking place in your local community.
All right, so I can buy that argument. However, if I look at a chart of the equal weight S&P 500 and I look at a chart of the Russell 2000, yeah, they're not at record highs, but they've made a marked recovery from the lows. Does that then mean that the overall economy and market are still trending in the right direction?
There can be a disconnect in there, but I think what you're really referring to, should we be at these levels? And it begs the question on valuation. But, stock market valuations don't live in a vacuum. Ask yourself, what's the competing asset class outside of gold? Do you really want to park your money in a 10-year treasury at 65 basis points? I'm being paid to wait 1.9% in dividend yield just to hang out in the S&P 500. So is there a disconnect? Yeah, certainly there is. There are parts of our economy that are still struggling. Even when we come back, they're going to be struggling. Close proximity businesses will never get back to the levels they were until there's at least a vaccine or a cure.
Let's talk about the retail picture in America right now. It's no secret that consumer spending is rebounding, but a lot of that, people say, has to do with the stimulus checks that went out and enhanced unemployment benefits. What happens if we don't get any kind of a resolution in Washington, D.C. to those issues in, say, the next few weeks or months?
I think it would be challenged for sure. I think we can all agree right now that America needs another bridge loan. But I don't care whether it's $1 trillion or $3 trillion. If in that package there isn't a pathway to getting America back to work, and that's going to be the challenge. If there isn't a pathway back, then it's not sustainable. We'll go back to the lows. And what I find disturbing is I hear some Fed voices like Anil Kashkari, Minneapolis Fed president, calling for a complete shutdown of the whole economy for 6 weeks. If we do that, these record highs that you're seeing right now will be a distant memory.
Okay. Let's talk about whether you brought up valuations before. Are they overextended right now? Is the market due for a pullback?
In a vacuum, they are. And certainly some parts of our economy, like cloud, which are trading, some of them don't even have a multiple. But I can go into shares like a D.R. Horton, where construction spending is very, very strong. It's almost a secular trend. I'm paying under 12 times earnings for a name like that. So you can pick and choose your spots. You don't have to hang out in this egregiously expensive areas. There are plenty of areas in the market right now that are very attractively priced.
Are you concerned about the elections coming up, David?
It's certainly the biggest near-term risk because likely with mail-in voting being at record levels, we're probably not going to know who the president is going to be in 2021 until, it could be days, it could perhaps be weeks. Also, the run-up, you're going to see a lot of sector volatility. Certainly healthcare, energy, even big cap tech are in the crosshairs of Washington, and the rhetoric in the next couple of weeks is probably going to cause some concern.